Hi everyone. So welcome to the stream today. Welcome to our live lectures on looking at some practice questions that we need to look out for, key areas that we have to focus on to put us in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. And we are going to be looking at some questions, solving some questions, touching on some key issues that you need to understand going into the exam hall, focusing on financial reporting, corporate reporting, the accounting standard issues. So let me hear from you. I see some of you guys joining. Give us a thumbs up on the video, share the video. Let's reach as many people as possible. If there are any questions you have also, you can put it in the comments or the chat for me. And I'm going to be answering your questions for you as we go into the discussion today. Give me a sec, trying to set up here. So we are focusing on financial reporting today, corporate reporting and financial reporting, and looking at those areas that we need to understand, looking at the accounting standards in the two subjects. So because accounting standards play a key role when it comes to our ability to pass financial reporting and corporate reporting examination, and your ability to understand the accounting standards will play a significant role because on the overall about 70-80% of the questions that you are going to be seeing in the exam hall, you would have to apply the accounting standards, right? You would have to apply the accounting standards. And so the accounting standards then become crucial for you to go into the exam hall and pass the examination. And so we want to go through a couple of principles on the accounting standards and then solve some questions as well alongside looking at some ICAG past questions and then see how we can set ourselves up generally as we go into the exam hall for July 2026. I believe your learning is going well, your studies is going well, you are technically working hard in the manner that you're expected to work so that you can pass the examination as well at the end of the day. Let me bring up my screen quickly so that we can begin the discussion real quick. Where is my screen? I think my screen is coming up. There we go. With my screen. Uh-oh. Give me a moment. Okay, let's go. So we want to look at question 2 ICAG March 2026. So just the previous examination date, March 2026 ICAG. Want to have a walkthrough on some of the questions there, some of the standards there, how we apply the rules, how we apply the principles generally, and see what else we can do as we proceed in the discussion. Any questions, put it in the comment section or the chat for me. Really want to hear from you as we get ourselves excited into the discussion. And we are live on multi-platforms, I'm told. So we are live on YouTube, we are live on X, we are live on LinkedIn, we are live on TikTok as well, all on the Nhyira Premium page. So in case you are on any platform and you're having any challenge, you can move on to another platform and then maybe you'll be able to have as well as we go into the discussion. So March 2026 ICAG examination, financial reporting, we are looking at question 2 and focusing on the accounting standards. Now, as you are preparing yourself for the examination, there are a couple of things I want to quickly share with you when it comes to the accounting standards. The first thing you must understand is that you are definitely going to be applying about 80% or 70-80% of the questions will be based on your understanding of the IFRSs, or what we refer to as the accounting standards. And so you go to question number 1, which is consolidated financial statement. The accounting standards are going to be following you there. You come to question number 2, the IFRS's dedicated question. You come to question number 3, single entity financial statements, whether you're doing cash flow or normal statement of profit or loss and statement of financial position. You come to question number 4, evaluation of financial statement. The standards are likely to follow you there. If you would have to make an adjustment to the financial statement before you calculate the ratios. Then question number 5, the theory areas, financial reporting students, that is also going to be a crucial thing that you must understand there. So about 70-80% of the questions will be based on the accounting standards. That's very important for you to understand. The second thing I want you to understand is that whether you like it or not, you're going to be having to apply some of the non-current assets accounting standards. Okay, so the non-current assets IFRSs, whether I like it or not, you will be calling on them in the exam hall, whether in the consolidated financial statements question, in the question 2 dedicated question, or whatever it is. You are going to be applying some of the non-current asset accounting standards. And this is where we are talking about IAS 16 property, plant and equipment, IAS 40 investment property, IFRS 5 non-current asset held for sale, discontinued operation, IAS 23 borrowing cost, IAS 20 government grant in respect of that. So these are crucial non-current asset related accounting standards that whether I like it or not, you are going to be applying them in the exam hall. Now, for those of you writing financial reporting, you don't have an excuse because whether I like it or not, IAS 12 is waiting for you in the exam hall. You will call on IAS 12 in the question 3 area, the single entity financial statement in respect of that. And that is what you need to understand when it comes to dealing with the accounting standards, right? So that's the second thing I want you to be mindful of. So number 1, 70-80% of the questions will be based on the standards. Number 2, non-current asset accounting standards will be there for you to call on them. And then you are going to be applying IAS 12, whether I like it or not, it's waiting for you. Then the third thing that I would want to let you understand is even the structuring of answering the question, your approach in the exam hall. Okay, as you've heard me say this over and over again, in the exam hall, it is how you can optimize yourself so you can pass the examination at the end of the day. So the question you need to ask yourself is, how do I optimize myself to pass the examination? Now, optimization of yourself to pass the examination means that you're going to go to question number 5 and answer all the theory questions you can first. Yes, the examiner is going to be having theory questions on sustainability, related issues, governance, okay, ethics, all right, some IT related issues, information technology, and even the accounting standards will follow you there into the question 5 area. So, and those are theory issues. You don't have to, worry a lot about calculation. They are going to be theory issues, 20 marks minimum. So you want to take that out first. Then, depending on your ability and your understanding of what is going on, you can then go ahead to look at the evaluation of financial statements question 4, right? After that, you can go to the standards or question 3, single entity. So by the time you are getting to question 1, which is consolidated financial statement, you are in a comfortable lead and you wouldn't have any problem or you wouldn't have any hassle at the end of the day. And that is what I want you to be mindful of when it comes to approaching the examination. Now, our examination analysis documents that will be shared for those of you who have enrolled in our courses, that will be shared individually in your respective classes for the detailed examination analysis document. But on the general overview, these are a couple of things that you need to be mindful of when it comes to dealing with the accounting standards and the examination as a whole. So let's go straight up. Question number 2, March 2026 financial reporting paper. Question 2A, the requirement here is, in accordance with IAS 24 related party disclosures, justify whether each of the above transactions require related party disclosures. Now, IAS 24 related party disclosures gives us guidelines on the importance of disclosing transactions that occurs between related parties. And so the question we ask ourselves is, who are related parties? So a transaction occurring between the company and a key management personnel of the company, the board chairman, key management personnel of the company. So if they buy something from the entity, or the entity sells something to them, or they loan money to the entity, or the entity takes something from them, that is a related party transaction. So transactions between the entity and key management personnel will be the first thing. The second thing is transaction between the entity and then the close family members of key management personnel. So if the wife of the CEO, the son of the CEO, the those kind of things, close relationship, the in-law of the CEO does a business with the entity, that is a related party transaction. It must be disclosed. Another thing is if we have two different entities that are jointly owned or jointly controlled by the same entity or by the same management, then the transaction occurring between them will also be regarded as related party transactions. So these are the few things that we must understand. Now, here is the play. The play about IAS 24 is that once we identify a related party, we must disclose it in the notes to the financial statement, even if at the reporting date, no transaction has occurred between the parties. And that is very important. So we can identify the related parties, but no transaction has occurred between them, or there is no transaction pending between them at the year ended. But the standard requires that we will still have to disclose that in the notes to the financial statement. So basically, these are the things that we must understand when we talk about IAS 24 related party transaction. Now, stay with me. On the backdrop of this understanding, let's get excited and look at the question we have here for 4 marks. Now, remember, 4 marks, 1.8 times 4, it means you're going to work with around 7 minutes. At least, or at most, you're going to do 8 minutes in respect of this particular question here. So let's see what we got. Senku PLC, a listed company currently holds the place of Ghana's top oil marketing company and is the only indigenous-owned petroleum marketing company in Ghana. It had the following transactions during the year. So 80,000 Ghana cedi raw material is purchased from Dondo Limited, a company 55% owned by the wife of the managing director of Senku. Okay. So transaction I is happening between who and who here? Transaction I is happening between two companies. So Senku, which is our company, buys from Dondo Limited. Now, we are told that Dondo Limited is owned by, so they own 55, the wife of the managing director of Senku owns 55%. Okay. The managing director of Senku is a key management personnel. So if Senku is doing a business with Dondo and the wife of the managing director owns 55% of Dondo, that means Dondo is a related party. So this is a related party transaction, hence must be disclosed in the note to the financial statement. That's the idea about that. Okay, so the wife of the managing director of Senku PLC, who is a key management personnel, controls Dondo Limited. As such, a disclosure is required as Dondo Limited is a related party of Senku Limited due to the relationship between the managing director and the majority shareholder. Something like that. I'm extending my write-up a little bit, but that kind of vibe. We are in class, so want to just flex a little bit, flex my muscles a little bit, but that's the idea. So this transaction is a related party transaction. It must be disclosed in the notes to the financial statement. That's the first thing we must understand there when it comes to this treatment or these transactions. I see some of you guys joining. You are welcome. We are looking at the IFRS masterclass, explaining the principles with practice questions. If you are getting some value, give us a thumbs up on the video. Most importantly, you can also share the video. We want to reach as many students as possible, get people to come watch the playback as well as, join the stream as well. So if you are getting value, let me hear from you in the comment section. If there are any questions, something you want me to share my thought on as well, put it in the comments or the chat for me. Second scenario. 120,000 Ghana cedi sales made to Chini Oil. Kekula Betty is the managing director of both Senku PLC and Chini Oil. Kekula Betty also holds shares in Chini Oil, which, if exercised, will give him a 5% holding. We don't really care about that second part, 5% holding. The fact that Kekula Betty is a key management personnel of the two companies means they are what? Related parties. Okay? So the two companies are jointly managed by Kekula Betty, who is a key management personnel. So, normally I want to bring in the name of the question so that the examiner get goosebumps about their names. So Senku Limited and Chini Oil Limited, Senku PLC and Chini Oil Limited are jointly managed by Kekula Betty. Okay. Kekula Betty, who is a key management personnel. All right. A key management personnel. Hence, the two companies are related parties and a disclosure is required. Or we can say is appropriate. Okay, it's appropriate. The reason I'm just doing that is because in the first one I said disclosure is required. So if I want to spice things up, I'll just say it's appropriate. Okay, just spicing things up, trying to use different words, not repeating the same thing, that kind of vibe. As I say always, you don't repeat the same thing like you are from KG2. No, you got to flex a little bit that you understand grammar. So that's the second scenario, also a related party transaction, because the two companies are jointly managed by Kekula Betty, who is a key management personnel. Okay. Third, if 40,000 Ghana cedi loan was made to the finance director of Senku PLC last year, was repaid in the current year. Stay with me. So if you look at it, the loan to the finance director of the company, finance director is a key management personnel. So the finance director being a key management personnel, a transaction between them is a related party transaction. So a disclosure is required. Now, you got to be careful here because If you think, you'll be like, the person has paid the loan in the current year, so there is no loan outstanding. You are right. The person has paid, there is no loan outstanding, but a disclosure is still required in the notes to the financial statement. So that is the third one. We will make a disclosure as well. The loan to the finance director is a related party transaction, as the finance director is a key management personnel. Although the loan has been repaid, in the current year, the disclosure of the transaction is still required as per IAS 24. Something like that. So that's the third one. Very sweet, simple, straight to the point. We done. There. Ivy. 55,000 Ghana cedis sales made to Tikobo Limited, a company 25% owned by Nhyira Baby Dad, a 30% shareholder in Senku PLC. Nhyira has a seat on the board of both companies. Now, you got to be careful here. Do we make a disclosure? Yeah, we need to make a disclosure. You got to be careful. Why are we making a disclosure? We are making a disclosure because Nhyira Baby Dad has representation on the board of both companies. So we make a disclosure for that as well because it's a related party transaction. So Ivy Nhyira Baby Dad. It's like baby daddy. Nhyira Baby Dad has a seat on the board. Of both companies, making Nhyira, is he a male or female? I don't know. Making him or her a key management personnel. Okay, a key management personnel. Due to this, the sales made to Tikobo Limited by Senku PLC is a related party transaction and must be disclosed in the notes to the financial statement. Something like this, and we are done. That is the idea about this question. So you are doing this for 4 marks. So it's a rapid fire, like you read, boom, you apply, you read, boom, you apply, you read, boom, you apply, because you have only 7 minutes, at most 8 minutes to work with this particular question. So that's it. IAS 24, related party transaction. So the first one, disclosure will be required. The second one, disclosure will be required. Third, disclosure will be required. And then fourth, disclosure will be required. These are the things that we must understand when we talk about question number 1. Any questions? You raise, I say you raise your hand like somebody's on Teams with me. You put it in the chat for me or the comment section for me. I'm going to be seeing your comment and bringing them up where appropriate. Okay, so this is from who? Genesis. Good evening, Nhyira. Thanks for your mentorship. We are grateful. All right, it's a pleasure. Thanks for joining us on the stream. Okay, I need to pull this chat also up. So that's the A aspect of the question. Easy peasy. IAS 24, related party transaction. Next one, B. For 7 marks, the examiner is asking us, so 1.8 by 7, 13 minutes. Let's see. In accordance with IFRS 16, leases, determine the liability component that will be shown in Jamal's statement of financial position as at 31st December 2025. Now, you got to be careful here. So the examiner is just asking you about the liability to be shown in the statement of financial position. I always emphasize on this about the issue in respect of the context of the question. The examiner didn't say, determine how the above transaction will be accounted for in the financial statement of the company. If he had said that, then possibly the asset that they have leased, any depreciation may have to be recognized in the P&L, finance costs may have to recognize in the P&L, then the liability will go to the statement of financial position. Here, the examiner is just focusing on the liability component that will be recognized in the statement of financial position. So you mind your business, you stay in the lane and stay in the ambit of the question. So let's see what we got here. Jamal Limited, Jamal, entered into a finance lease on a machine as lessee on 1st July 2024. Now, it's quite interesting in the context of this question why the examiner is using the word finance lease here, because under IFRS 16, it is the lessor who is supposed to classify the lease as to whether it is a finance lease or an operating lease. The lessee is going to just account for the lease either by the default method, that is recognize right of use and recognize the lease liability, and then depreciate the right of use over the lower of the lease term and the remaining useful life. But if it is certain that there will be transfer in the ownership of the asset at the end of the lease term, then we use the economic useful life to depreciate the asset. That's it. Or we apply the low value method where although the lessee has leased the asset, they will account for the asset as a normal rental. So no recognition of right of use, no recognition of lease liability or lease obligation in the books of the financial statement. So it's just quite interesting because sometimes some of these questions are old questions adapted, and so when they are adapted, sometimes it becomes confusing. But that is what you must understand, because under IFRS 16, it is the lessor who classifies the lease as to whether it's a finance lease or operating lease. The lessee has no business doing the classification. So just a clarity. I'm not saying the question is wrong. I'm just letting you understand the context of the spirit of the standard in respect of that, because sometimes the question can have some nuances, and if you think critically about it, you'll be like, why is the examiner doing it? Just overlook it and go to the context of the question and go away. So they entered into the lease on 1st July 2024. That's an important information for us. That is the inception of the lease, 1st July 2024. Covering a period to 30th June 2030. What the heck? covering a period of 30th June 2030. The lease requires 12 payments of 20,000 payable on 31st June and 30th June each year, commencing on 31st July 2024. So if you check here, the lease payment is 20,000 biannually or half yearly. Now, if the first payment is going to start on 31st December 2024 and the lease inception date was 1st July 2024, it means this lease payment is made in arrears. The reason why that is important is because it will then affect our amortized cost schedule for the subsequent measurement of the lease obligation. It will affect us in respect of that. Jamal incurred legal cost of 4,000 to set up the lease. Okay. So what do we do here? Further details of the lease are as follows: 200,000 interest rate implicit in the lease, half yearly. You got to be careful because if that was not, the half yearly was not in bracket, okay, half year rate was not in bracket, then whatever rate the examiner would have given us would have been for the year. Then you would have to divide that by 2 to get the biannual rate. You got to be careful. Sometimes the examiner will be lenient to make things flexible for you. Other times, he wants to squeeze life out of you and bring the best in you. So in that case, you have to be careful about how you structure your answers out. The present value of the minimum lease payment has been given to us to be this figure, 187,702. Okay. Jamal uses the actuarial method of allocating the finance charges. Okay, that's it. We're done. Remember again, the question didn't say determine how Jamal will account for the above transaction. The examiner only said determine the liability component that will be shown in Jamal's statement of financial position. So all we are doing is the liability component. So let's look at it. So B, in respect of that, so I'm seeing a question coming up here. Ruth said, can you pull all together and say it is related party and needs a disclosure in the notes? Is it? No, you can't do that. Hey, sister, you read all of them, then you put the answer together. No, you don't do that. You can't do that. Because the requirement of the question said, justify whether each of the above. So you have to write for each of them individually. You cannot put them together. All right? You cannot put them together. So we go straight because we have the minimum lease payment to be 1/8. So we can look at the amortized cost schedule. So the lease obligation for the amortized cost schedule. We're going to have the year. We're going to have the balance brought forward. We're going to have the interest. Because payment is made in arrears, interest will come. Then we bring in the lease payment. Then we get a closing figure, balance brought down. So slashing our currency sign, Ghana City. Now, because payment is made in arrears, we have to do the schedule for 2 years. Stay with me. Because payment is made in arrears, we have to do the schedule for 2 years. What does that mean? It means we will do the schedule for the year ended 31st December 2025 and do the schedule for the year ended 31st December 2026. So that the 2026, the next year closing figure, will become the non-current liability. Then the difference between the 2025 and 2026 becomes the current liability. So we will do the schedule for 2 years. The current year ended under review and then the next accounting year, so we can get our split coming in respect of that. Stay with me carefully and see how it happens. So from 1st July, we will end on 31st December 2024. So give me a sec. Let's see if I can bring some things here. 4% interest rate implicit in the lease. What do we have? 702. So we do 4% on that. 0.04 by 187,702. And that is 7,508. The lease payment biannually, we are told, is 20,000. That's going to be subtracted, so we get a closing figure. So 187,702 plus 7,508 minus 20,000. And that is 175,210. So that will come on 30th June 2025 as the opening figure, 175,210. Charge the interest rate. We bring in the lease payment times 0.04. That is 7,008. Okay, 7,008. Then we punch the arithmetics for that. What do we have? 175,210 plus 7,008 minus 20,000. And that is 162,218. Remember, you are working for the year ended 31st December 2025. We are now at June 2025. So the next one is 31st December 2025. So the closing at June 2025 will come at the opening here, 162,218. We're still going to make our lease payment, 4% on that. And that is 6489. All right, 6489. Then we do the arithmetics, 162,218 plus 6489 minus 20,000. And that is 148,707. Now, this 148,707 is the liability at the end of the year, 2025. But you see, that 148,707 must be splitted between current and non-current. So because payments are made in arrears, and nothing that we have to do for the next accounting year, so that the closing figure for the next accounting year becomes non-current liability, then the difference between that figure and this figure becomes the current liability. That is the flow here. So we will do 30th June 2026, 148,707. So 148,707 on 4%. That is 5,948. We get the arithmetics, 148,707 plus 5,948 minus 20,000. And that is 134,655. Then the last one, 31st December 2026. And that is 134,655. 20,000 times 0.04, 5386. So we get the arithmetics coming up, 134,655 plus 5386 minus 20,000. And that gives us 120 and 41. Now we are home. So the non-current liability of the lease obligation. So let me put it this way. On the face of the statement of financial position, we'll have lease obligation above a year. It will be the 120 and 41. But the total liability is 148,707, which is the carrying amount we got at the reporting date, 31st December 2026 here. So the balancing figure becomes current liability. So lease obligation below 1 year will be the balancing figure. So minus 148,707, and that is 28,666. This is the answer to the question. That's all. We are done. Now, assuming the lease payments were made in advance, the schedule would have been different, okay? And the structuring would have been different. We would have brought the lease payment first, got our capital balance, then we'll calculate interest. In that case, you don't have to work for the next accounting year because the closing figure for that year will be the total liability. Then the next lease payment will be current liability. Then the difference between that, the balancing figure becomes the non-current. In the context of this question, that is the answer to the question for 7 marks. That's all. Because the question didn't say, explain how the above transaction will be accounted for. That's not what the examiner said you should do. It just said, calculate the liability component. But I'm in class, okay? So if we were supposed to account for the right of use portion, how will it look like? So permit me to bring that up as well. Let's account for the leased asset or the right of use. So we bring in the present value of the minimum lease payment. As given in the question, to be 187,702. Then, remember we said the initial cost of an asset shall be the purchaser's cost plus all other directly attributable costs incurred in bringing the asset to its present use. So if you check in this question, they incurred a legal cost to set up the lease. Jamal incurred a legal cost of 4,000. So that must be added to the right of use because it is a directly attributable cost incurred. So we add legal cost, 4,000. If there was any reimbursement from the lessor in respect of that legal cost, then we would have taken that into the as a deduction. It will reduce the amount we are going to be including here. So that now, on 1st July, the initial cost of the leased asset at 1st July 2024 would have been this plus 4,000. That would be 191,702, right? 187,702 plus 4,000. Yeah, 191,702. That will be the initial cost at 1st July 2025. Now, remember, we are told that the lease is going to end on 30th June 2030. So it means the lease term is going to be what? July to June. So 25, 26, 27, 28, 29, 30. So 1, 2, 3, 4, 5, 6. So it means the lease term is 6 years. Because if you are paying 12 payments half yearly, it gives you 6 years. So the lease term is 6 years here. So we're going to charge depreciation. Now you got to be careful because the lease was arranged on 1st July. So we will charge the first depreciation to 31st December 2024. So we less depreciation to 31st December 2024 first. And that's going to be 191,702 divided by 6 years, which is the lease term, times 6 over 12. Because that's going to be half year. So my answer divided by 6 times 6 over 12. And that's going to be 15,975. So that's taken out so that we get a carrying amount. Again, this is not part of the question, okay? But I'm in class, so that's what I'm showing you. 191,702 minus 15,975. So that'll be 175,727. Then we can charge the depreciation for the current year ended under review. So we charge depreciation for 31st December 2025, which will be a full year depreciation. And so that's going to be 191,702 divided by 6 years. We were not given the economic useful life of the asset because, as I mentioned in the introduction, if we're given the economic useful life of the asset, then we'll look at the difference, the lower of the two, economic useful life of the asset and the lease term. The one that is lower will become the one we will use to depreciate the asset. But if there will be title transfer at the end of the lease, then we will use the economic useful life of the asset. So we will charge a full year depreciation here, 191,702 divided by 6, and that is 31,950. So in the context of that, carrying amount at 31st December 2025 would then look like this. 727 minus 31,950, 143,777. So this would have been how the workflow will be. And so if we then put the two together, then for Jamal, statement of profit or loss for the year ended, which is going to be an extract, will have the depreciation on the right of use asset, which is 31,950. Okay, 31,950. Then we bring in the finance cost, which will be from the lease obligation schedule we prepared. The finance cost for 2025 will be the addition of these two guys, the 30th June 2025 and the 31st December. So the addition of these two guys, because it's biannually, that'll be 7,008 plus 6,489. And that'll be 13,497. Now, these are all cost items, so you can leave them like that, or if you want to put them in brackets. It's an extract financial statement. Then in the statement of financial position, also an extract, we would look like this. Under non-current asset, we will have the leased machine, or if you want, right of used asset. And that's where the carrying amount will come, 143,777. 143,777. Then under liabilities, we'll have non-current liabilities or liability. Then we'll have current liability. And that is where the lease obligation split we did will come to play. That's it. So the non-current liability is this figure. And then the current liability is this figure. So assuming we are comprehensively answering the question, this will be how the statement of financial position would also look like. Very sweet, simple, straight to the point. But that is not the spirit of this question, because this question only required us to do this one. The liability amount that will be recognized in the financial statement of the entity. That's all. So you have to be careful about the context of the question to not just jump and do things you are not asked to do. You get it? You need to be careful to not just jump and do things you are not required to do. Here, you are just doing the liability component. If the question was together and we are supposed to account for it, then we would have done this, and then extracted this comprehensive financial statement. So that is the answer to the question there. Eugene Aku said, just like an amortization schedule. Yes. I think you're talking about the lease obligation, the amortized cost schedule in respect of that. So that is the answer to B with an extension, okay? With an extension, because I have to clarify that with an extension, because you need to always stay within the ambits of the question. You need to always stay within the ambit of the question. Okay, let's look at the third one, C. What does it say? In accordance with IAS 10, events after the reporting period, prepare a briefing note. Advising on the accounting treatment with respect to each case, I and II above, for 5 marks. Okay, I and II above for 5 marks. Okay, IAS 10, events after the reporting period. So these are events are happening after the end of the year, but before financial statements are authorized for publication. What we mentioned is that if there is an event that is giving us further information about a transactional or something that had existed at the reporting date, then that becomes an adjusting event. An adjusting event means that the financial statement will require amendment. The financial statement will require an adjustment. But if the subsequent event is not giving us additional information about something that had existed at the reporting date, then it is a non-adjusting event. And where the entity considers the event to be material, then a disclosure would have to be made in the notes to the financial statement. Easy peasy. That's IAS 10, events after the reporting period. So let's go. What we got? Fonton From Limited. Fonton From is a distributor of frozen chicken, beef, pork, mutton, turkey, fish, and many more. Okay. Fonton From is in the process of finalizing its financial statement for the year ended 31st March 2025. The draft statements were completed on 14th May 2025, and the audit is currently in progress. The financial statements are expected to be approved by the board on 15th June 2025 and published on 20th June 2025. So stay with me. So between the year ended 31st March 2025 and the dates that financial statements are authorized for publication, 20th June 2025, anything that happens between that period will be regarded as subsequent event or event after the reporting period. And that is what we said. If it is providing us with additional information or further information about something that had existed at the reporting date, then it is going to be an adjusting event. But if not, it will be a non-adjusting event. And if it is material, a disclosure will be required in the note. So let's come. The following matters have come to light during the audit, and your professional advice is requested. No adjustment has been made in respect of these matters. 1. Closing inventory at 31st March 2020 includes 100 items carried at cost of 5,000 Ghana cedi each. New safety regulations were announced on 5th May 2025 with immediate effect. This item of inventory do not comply with these regulations. As a result, the net realizable value of the inventory is only 4,500. Now you got to be careful here. Inventory should be carried at lower of cost than net realizable value. So if you're not careful, you just be like, ooh, the cost of the inventory is 5,000 cedis and the net realizable value is 4,500. So we have to write down the inventory because the inventory has suffered an impairment of 500. Hey, take it easy. Take it easy. What is causing the net realizable value computation? That is the event. The event causing the net realizable value issue here is a new safety regulation. That new safety regulation was not there at the reporting date. So it means there is no indication at the reporting date that there will be any new safety regulations. For that reason, this is a non-adjusting event, but could be considered material. Hence, a disclosure may be appropriate in the note to the financial statement. That is all. We are done. That's the answer to the I aspect of the question. Now, again, understand what's going on here. If they had sold the goods, and when they were selling the goods, they got 4,500. Then the sale of goods, because revenue after the reporting date indicates that at the reporting date, the inventory has suffered an impairment. So we would have said, oh, it's an adjusting event. But the issue triggering the net realizable value being lower than the cost is a new regulation, which was not at the reporting date. So this new regulation is a new regulation. It has no bearing on what was happening at the reporting date. So the inventory will continue to be carried at 5,000 Ghana cedis in the books of the entity each for the 100 item, 5,000 cedis each at the reporting date. But this is a significant event, and so a disclosure to the notes or in the notes will be appropriate. So that is the idea about that, and that is the answer to the I aspect of the question. II. An investment in unquoted equity investments was held by Fonton From at 31st March 2010 at an amount 2025 at an amount of 3.5 million. Listen carefully. This was its fair value on 30th April 2024. Okay. So this 3.5 was its value 6 months ago. Okay, 6 months ago. Due to unavailability of a professional valuer, an updated fair value was not available until 15th of May. On this date, the valuer provided an estimate of fair value of 2.8 million. So if you look at this story here, the entity is carrying the investment at 3.5 million. But the investment would have to be remeasured at the reporting date. But we are being told that at the reporting date, there was no valuer available. The valuer only came in after the reporting date on 15th of May. So unless otherwise there is another information given, this new value given to us by the valuer is an indication that the investment has suffered an impairment all this while. For that reason, this transaction is an adjusting event. This transaction is an adjusting event, and the equity investment must be written down 3.5, 2.8 by 0.7 million Ghana cedi. That is the answer to the question. So you see how interesting the story is woven here. Yes, the valuation is being done after the reporting date. But unless otherwise there is something else, it is telling us that if the valuer, the professional valuer, was available at the reporting date, they would have given us the 2.8, which would have confirmed that the thing has suffered an impairment. But since they are coming after the reporting date, it still tells us that there is an impairment in the item. That's all. We are done. So the second scenario is an adjusting event. The equity investment must be written down to 2.8 million with a 0.7 recognized in the profit or loss account. That is the answer to the question there. IAS 10, events after the reporting period. Very sweet, simple, straight to the point. Any questions? Everybody good? That is the idea here. So you see that everything we are doing, as I say always, is just about, hey, how the examiner has set the question, your understanding of the standard, and the application of the principles based on the standard at the end of the day. Because if you can apply the principles based on the standard, you'll be in a comfortable lead at the end of the day and not have to sweat it at all. Not have to sweat it at all. The last one, IAS 23, borrowing cost. The question here is very simple for 4 marks. It says, when should capitalization of borrowing cost commences and ceased? I don't need a miracle on this, but let's read a preamble. IAS 23 borrowing cost requires that borrowing costs directly attributable to the acquisition, construction, and or production of qualifying asset must be capitalized as part of the cost of that asset. Where funds are borrowed specifically, costs eligible for capitalization are the actual cost incurred less any income earned on the temporary investment of such borrowings. Where funds are part of a general pool, the eligible amount is determined by applying a capitalization rate to the expenditure on that asset. The capitalization rate will be the weighted average of the borrowing cost applicable to the general pool. So in the context of this question, the preamble has no bearing really on the requirement of the question. So when should we start capitalization? Pretty simple. Capitalization of borrowing cost commences when expenditure is being incurred, right? So we are spending money. 2, borrowing cost is being incurred. So we are paying for the interest or interest is due. And then 3, activities necessary, okay, to complete the asset or make the asset ready for its intended use are ongoing. Then we can capitalize. Then the second part is cessation of capitalization. Capitalization ends practically when the asset is ready for its intended use. Okay? When the asset is ready for its intended use or sale, or when significant portion of the asset is ready, left with just some minor works to be done to make the asset ready for its intended use. So that's for 4 marks, theory area, IAS 23, borrowing cost. And that's all about it. So for 20 marks, 36 minutes, students were required to apply IAS 24, related party disclosure, IFRS 16, leases, IAS 10, events after the reporting period, IAS 23, borrowing cost. And that's the beauty of the question. Now, in corporate reporting, this is going to go into 30 marks. So you are likely to have 6 accounting standards because question 2 and question 3A are all going to be accounting standards, taking us to 6 or in some cases 7 standards before we come to the other nuances at the end of the day. And these are the things you must understand when it comes to these questions on financial reporting, March 2026 examination. Now, if you are interested in getting access to a lot of questions like this coming from ACCA, ICA, ICAEW, SEMA, ICAN, practice questions like this to get access to a lot of questions solved like this, presented like this, then you can head on to our website to enroll in our practice question courses. Because our practice question courses gives you this kind of ability where you'll see the questions, then we discussed and solved it like this a lot, and they are categorized into the various segments of the syllabus to open you up so you get access to the questions and the solution, so you can download them, soft copy and use. Then you get access to the lecture videos on our website as well as in the Nhyira Premium mobile application that you can download and watch over and over again to build your knowledge. And we have the courses available for financial reporting, corporate reporting, public sector accounting and finance, financial management, management accounting. So all of these are available. So you can enroll in our full practice question course on the website, because at this point, 2 weeks to go, this week is out, 2 weeks to go, you need to expose yourself to as many questions as possible and see how the principles apply in various scenarios. So you can head on to our website, check the link under this particular video, nhyirapremium.com, or download the Nhyira Premium mobile application so you can get access to enroll in some of these courses to help you prepare for the examination. If you have any other questions also, you can send us a message on WhatsApp or call us, +233 if you're outside Ghana, but 050-114-9296, 050-114-9296. Listen, if you can expose yourself to guided questions like this, where you are not just seeing questions and solution and you're scratching your head, hey, how did the examiner do this? Hey, this marking scheme. Hey, already I'm tired. But you are guided through a workflow like what we just did, and you want to get access to more of that, then certainly our practice question videos are what you are going to be needing to aid you on the journey so you can prepare adequately to pass the examination. So we're going to wrap up here today, and we'll continue with our discussion in the next session. Make sure you subscribe to the channel, stay connected on all our platforms so that immediately we go live, you will be part of it to get the notification. And you can also join the Nhyira Premium Network available on WhatsApp, and you'll be able to get update to various things that we're going to be doing. We're going to be coming your way with a lot of these exercises throughout in the next 3 weeks that we have, this week inclusive, as we continue for July 2026 examination and see how we can prepare you adequately to pass the examination. So we're going to be coming in from other subjects as well, not financial reporting and corporate reporting alone. Management accounting will be coming in, public sector will be coming in, taxation will be coming to town. So we're going to be coming in, interestingly, from various areas as we prepare you to go into the exam hall and pass the examination. So thanks for watching. Thanks for the likes, sharing, and the comments and the contributions. And I'll catch you in the next one as we continue with our discussion. Stay safe and stay blessed. Bye-bye.